This week, however, we have the topic of what home ownership really means. Now, this senior devil there, he looks happy. He looks like a healthy fella, but he's holding a lot of cash. And that is because, as the screen points out, national average is that 80% of one's retirement savings comes from real estate. And of course, real estate, by and large, is the largest financial investment a family or an individual will partake in, be involved in a lifetime. Whether you buy one house and stay in it forever, or you buy multiple houses, probably the largest financial investment you'll ever make. And at least in my opinion, real estate is by far one of the best investments, period. Sure, there can be some downturns in the market, but the national average of 3 to 5% appreciation is outstanding. So if you were to buy a $100,000 house, if they exist any longer, but that makes it easy math, you're going to gain $3,000 to $5,000 a year just in appreciation. And remember, you got to live somewhere. So if you're living in a property that you own and it's gaining appreciation, isn't that so much better than renting? Not to mention that renting often is more expensive than owning, at least in reference to the principal, interest, tax, and insurance payment that you would be making. So you do always have to consider, because that's a bold statement to say that renting is more expensive than owning. So obviously we did clarify that by principal, interest, tax, and insurance. So your payment in most cases is less. And even if it isn't at first, it certainly will be in the future, because renting generally increases their payments by 5% every year. So instead of you gaining 3 to 5% appreciation on your real property, your payment on a rental is increasing by 5%, which could be a really good segue into buying investment properties, because not only are you gaining appreciation of 3 to 5%, but you're also gaining on the payments you receive from your renters of 5%, which is the limit, the max for California. However, we're not segmenting into that section. We are talking about, however, the other expenses of home ownership. Remember, the title of this is Home Ownership, What It Really Means. So it does mean those things that we talked about, but it also has to go into the upkeep. It takes money to keep these properties up. Everything has deterioration and everything has a life cycle. And so you do have to maintain a property. Also, often you're going to want to customize or improve the property. These are things that are going to require money. Will it really cost you 3 to 5% a year? Will it cost you all of your appreciation? No, typically it does not. And it varies from family to family depending on what they want to do. But those are certainly expenses that we want to have right out there in the front, make sure that we understand them, that owning real property does require those types of expenses. Of course, one of the other things to consider in buying a home is that your neighbors aren't going to change. Well, they might move, but they don't move as much as a renter next to you. So you got to be happy with the neighbors. But there are, obviously, and I like to compare and contrast, I like to throw in the pros with the cons, that there are tax advantages as well. Now, next week, we're going to meet with Angela, which she is a tax accountant and professional. She knows an awful lot more about the advantages of real estate and taxes, in reference to taxes, than I do, which is why we're having her on as a guest speaker next week. But one of the other things about real estate when buying a property is you can't really move every year. Now, tongue in cheek, you could certainly move. You could buy the property, live there for a year, 6 months, 2 years, and then you can rent it out and move. But generally speaking, if you buy some real estate, you need to probably stay there. And as we spoke earlier in one of the previous segments, you don't want to own real estate for less than 3 years. Generally speaking, the amount of cost of buying a property and selling a property is going to strip your 3 to 5% if you sell prior to 3 years. If you keep it 3 or more years, you generally have enough appreciation to cover all of those costs. So Just something to note. Also, on the side of owning property is all the extra expense. So when you rent, you generally aren't paying, what's the list? Water, trash, electrical, internet, cable TV, certainly not paying probably pest control or for termite abatement, um, probably not paying for lawn care, but these are all possible expenses, some must expenses, and some possible expenses of owning real estate. And however, it does lead to the pride of ownership section because owning a home, gosh, for those of you that do own a home, you know the feeling. For those of you that don't, you still know the feeling because you haven't experienced it. You know the desire and the angst of renting and throwing that money away every single month. Yeah, you have a domicile, you have a roof over your head, you're covered, you're protected, you're private, lock the doors, it's all good. It's yours for 30 days. But when you own property and you do put that extra money in to customize it and make it your own and fix that little leak over here and stuff, the pride of ownership is tremendous. So you certainly gain that by owning a property. And yeah, you can say at the end of the day, I'm going home and mean it. And there's certainly something to that. So what about owning it? What about all that equity? So we have spoken lots about 3 to 5% on average, national average. Um, Equity is gained every year. So what about that equity? What can we do with it? Well, of course, being a mortgage and real estate professional, I have seen a lot of people just take that cash and go buy a big boat, an RV, go on vacation. I've seen it, and that's okay. It's your money, you do whatever you want. Probably not the most fiscally responsible choice, but it's an option. And would you have saved that much money if you hadn't owned the property, owned real estate? Probably not. So it's okay, but better off you could take that equity and put it into something like perhaps another piece of property or your kid's retirement university. Yeah, there you go, schooling. But I have certainly seen, and there's loans to help with this. You can do a cash out refi and use that cash to perhaps build a casita or an additional unit. They're generally referred to as an ADU or um, separate unit. So you can build that, you could rent it out, your kids could live in it, your grandparents could live in it, your parents could live in it, you could move into it while the kids take over the main house. You do a lot of stuff with that. And or you can Airbnb it, or perhaps just even Airbnb one of the rooms in your home, take that extra income and apply it towards principal. If you were to put that on the HomeBot app that we have available for you, and all you have to do is simply ask for it and we'll send it over to you. But if you were to put that in the HomeBot app, it would be really surprising. You would be wonderfully surprised how many years it cuts off of the amortization of your mortgage if you were to rent one room, put that amount towards principal. It's amazing. Of course, when owning real estate, primary residence generally is what I'm speaking of, you can rent the entire house while you go on maybe a mission or extended vacation, or maybe you're really relocated for work. So owning a piece of property doesn't have to lock you down. You can rent it out. I'm not comfortable with renters. I've heard all the stories. Yeah, I understand. And it on occasion can be a pain. You can turn it over to a management company as well if you're relocated, and then have no worries then. But lots of things you can do. So don't think that I don't want to be tied down. Well, rethink that because you could certainly get involved in it and then rent it out. Lots of so many options, but in reference to renting it out, let's just explore that real quick. Although I'm sure you've already thought of it, but if you rent the property out, that amount of rent, which is almost assuredly the amount of the payment or more, they're making your payment. The property is still appreciating 3 to 5% a year. That's a fantastic investment, an investment that appreciates 3 to 5%, of the value, not of the payment or of the amount that you put down when buying the property, and somebody else makes the payment. Wow. To me, that's a winner. So I bring this slide up because last week, my buddy Michael Dore, he recently out of the Coast Guard. Fantastic guy, young guy, as you can see there. He runs a chainsaw for a lumber crew. He would illustrate that better than me, but he's a stud. So he's a first-time home buyer, and he bought a 3-unit property in 29 Palms. I bring this up because, A, he's a first-time home buyer, and he thought about it being an investment, not so much about him. He didn't particularly want to live in 29 Palms, but he used his VA loan, which is 100% financing. He bought in a military city because there's a Marine base there, and that's great rents, but low values. So he bought a very affordable 3-unit property. He lives in one and rents out the other two. The payment he receives from the 2 units he rents makes his entire payment. Makes his entire payment. How fantastic is that? So certainly that's an option for you, as well as we spoke about just renting rooms. Um, his buddy is in the Coast Guard in Galveston, Texas. He bought a 3-bedroom property that was within skateboard distance from his station. He rents out 2 rooms to 2 medical students, and that rent pays the entire payment. So, that was just a single family residence. It was 3 bedrooms, rents 2 out, lives in one. Michael, he goes a little step further, buys a 3-unit, rents out 2, lives in it's. I love that these guys are thinking and using the benefit that they earned. Fantastic. Congratulations, guys. Um, Also, in reference to real estate being an investment, you can certainly buy your children that are going away to college. You can buy them a condo, a single family residence as an owner occupied, not because they're earning enough money to be on the loan, but because you earn enough money to finance the loan, to afford the loan, to qualify for it. It's considered owner occupied, and the key term there is it's a kiddie condo. It can still be a single family residence or a condo or a townhouse, and certainly can be multiple bedrooms, in which case you can rent the other rooms out to help make those payments. But that's a great investment, probably safer and more responsible than the dorms. I don't know, but certainly an option. As well, the reverse of that is you can do a kiddie condo on the parenting side. So if you want to buy a property for your parents to live in, that's just same thing. It's a kiddie condo, same terminology. They may have come up with something within the last 6 months that I'm not aware of, but that you can buy as an owner occupied. Even when your parents can't afford to make the payments, you buy it owner occupied for them to live in. So lots of options available. Certainly let me know if you want to chat about any of that kind of thing, because works out fantastic. Um, and just briefly, of course, you can always buy a house to use as a vacation destination, as a second home, which are the same loan to value as owner occupied, and better than investment loans. And assign it to a management company and collect the rents. They collect the rents and deposit them for you. And of course, then you can enjoy that property whenever you want. I would be remiss if I didn't throw in pretty quick just a little bit about retirement loans. Retirement loans are commonly known as a reverse mortgage. You do have to be 62 years or older in order to qualify for a reverse mortgage, but there is no income qualifying because there's no payments. Now, you certainly can choose to make a payment, and if in the future you hit hard times and you're like, man, I wish I had all those payments back, well, you just call them up and tell them, hey, I want my money back, and they give you your money back. There's lots of different scenarios or options with a reverse retirement mortgage that I love presenting on because it helps our seniors, at least 62 plus, which isn't very old. And a lot of people misunderstand a reverse mortgage and they think that you're selling the property to the bank. It's not true. It's simply a loan. It's a government loan, just like if you were going to go get an FHA or a VA loan. It's simply a loan. When you pass, your property still goes on to your heirs, whoever you willed it to, and it has that lien on it, and it gets paid off by your heirs selling the property, or they refinance it and turn it into investment property. They move into it, whatever. It is a normal loan, and the lender definitely does not own it. You know, a reverse mortgage can also be to get you cash. You can do a cash out reverse mortgage, and you can also do a purchase reverse mortgage, which is where you put a large sum of money down, but then you never make another payment. So that's all about the equity and how long that equity is going to be able to, with appreciation, be able to afford those payments. So very nice. Just a little tidbit on that, because again, I love reverse slash retirement mortgages. Let's say a 62 plus person marries a younger person. Well, the older person passes away and the younger person is concerned that they may not be able to retain the property. As long as that younger person's spouse is written into the loan, then they as well remain in the property until the day they pass. So that's another misunderstanding in reference to retirement slash reverse mortgages that are, I think, important to note. Okay, enough about that. This segment that we are on could have gone a lot of different ways, but I wanted to really hammer through all of that aspect. I think there was some good information in there, but I have a wow item. I really do. And I made time for this to make sure that we talked about it. I had some clients in yesterday and they were thinking, I don't know if this is a good time to buy. I don't know if it's a good time to. So here's the facts. And seriously, these are facts. You can look them up. 8.6% of the nation is currently in forbearance. You may recall that the federal government said, was it in March, that if anybody couldn't make their payment for any reason, you don't have to give a reason. You simply call your servicer and say, hey, I can't make my payment. I would like to be in forbearance. Forbearance means you don't make a payment. And it's up to the servicer as to how they negotiate with the homeowner that's not making the payment, what they're going to do in the future. Often they'll put the entire amount onto the end of the loan, which just simply increases the amortization, adds years onto it, or there's a balloon payment at the end. They can split the payments up and just add them on when you do choose to start making payments. There's a lot of different things they can do, but the point is that the federal government said that people that are renting and owning homes do not have to pay their servicer for 6 months, and they can renew for an additional 6 months if they choose, again, without cause or reason. They simply have to request it. So 8.6 are in forbearance, 8.6% of the nation, which is down 0.2% from last week, as it was 8.8%, but that's $995 billion. That's almost $1 trillion that is not being paid. That's amazing. Now, here's how this works. So there's investors that buy mortgage-backed securities. Certainly they want their money, but the servicer gets paid. Generally, it's only like 15 bucks a month to receive a payment, but they get paid to receive payments and distribute the payments and the escrow amounts and the different pieces of that one payment. The servicer is on the hook for the payments. Depends on the contract, generally for 6 or more months. So if the homeowner is not making the payment, the servicer must make the payment to the investor. How much money does the servicer have? Well, the servicer doesn't have this kind of money, so they can't last forever. That's going to be a problem for sure. But if the rest of the people, let's just keep on. Okay, so COVID is not recovering. There's a new spike. Obviously, there has been a new spike. California has pretty much closed down again. And 54,500 new viruses or new infections was reported by John Hopkins in a report. Can you, I mean, let's just look at all of that. 8.6% not making their payments. New spike, 54,000 plus new infections. Is this going to be a problem for real estate? I mean, let's think about it. Unemployment with the additional CARE Act of $600 has expired. It expires in July. So those that were on unemployment that are receiving an additional $600 are no longer receiving the additional $600, which was really advantageous for them to actually stay on unemployment. But if they can't go back to work and they aren't receiving the additional $600, they're even in worse position. So these are the ones we're talking about that are actually in forbearance and that are receiving the $600 additional that have actually gone on unemployment. But did you know that of the ones that are not in forbearance, 30% of homeowners and renters are not making their payments or paying less than is owed? 30%. So we're primed for many more forbearances because those not making payments or making less than eventually would ask for a forbearance, right? And of those additional forbearances, if we have 8.6 being $995 billion, and that's only 8.6%, what happens with this other 30%? I mean, is that gonna, what would it look like at 20% or even 25%? Can you imagine? Is there gonna be some foreclosures? I mean, what do you think? Here, here's what I'm thinking. I really kind of think that the mortgage industry, in reference to forbearances, that, forbearances are by far the last choice you want to choose. Um, Generally, forbearances lead to foreclosure, not in every case, but let's say 20%, which is low. If 20% of forbearances lead to foreclosure, won't we have many more foreclosures than we even did in 2009? And if there are that many foreclosures, and if that does erode the value of real estate in those areas, wouldn't that be a fantastic time to buy? But let's back up for a moment. Of those homeowners and renters, the homeowners in particular, there's so many other options to choose prior to forbearance. Um, one of the things that we're not positive of is, and it wasn't written into the federal guidelines, if you're in forbearance, would they hit your credit with non-payment? Let's say they don't hit it. Let's say everybody's being, really great about this event, and they're not going to hit your credit with a non-payment. The servicer tracks that, and when you go for a demand or a final payoff because you're refinancing the property, the demand is going to say late, late, non-payment, non-payment, non-payment. They're going to say all of that. So that means the underwriter is going to see that. And if the guidelines, and to date, the guidelines have not changed. If you're late, if you have one late within 12 months on a regular A-paper loan, you're not going to get that loan. If you have two late, you got to wait two. The guidelines are such that if you're in forbearance and you're not making payments, and that actually comes through on the, in the information that we research, then you're not going to get the loan. There's so many other options. You're much better prior to doing a forbearance to do a refinance, perhaps a cash out refinance so that you can continue making your payments. Or what about just sell the property? Values are up, interest rates are low. There is not enough inventory to sell property to all the people that want to buy property right now anyway. So why not just sell the property, take the cash, rent a little something, and wait for the market to go down to get back into the market when maybe your job has started back and those types of things. I mean, my point here is that the facts have been presented and there are more options than simply choosing to not make your payment. And I would really encourage you to look at the different options because you know, wrecking your credit, possibly going into foreclosure later, and and having to do a short sale after the market drops, probably much more devastating to your family than it is to do a cash out refinance and rent something for a while until everything gets back to whatever the new normal is. So that's just my thought. I just wanted to share it.